Well, there's been a lot of talk lately about the stock market breaking down technically, like we're on the edge of some kind of trapdoor moment. So, in this video, we're going to separate fact from fiction, and you're going to walk away feeling a lot smarter and more confident about how you're navigating your money. Today is Sunday, February 15th, and that's where I want you to slow down, because a moving average cross is not a verdict. It's a lagging summary of what already happened. It's like looking at your bank statement after a rough month and saying, well, I guess I'm doomed forever. No, it's information. Useful information, but not a prophecy. And the reason this matters is because a lot of people trade the symbol and ignore the plumbing underneath it. So before we talk about what the averages might do, we have to talk about what the money is actually doing. Because right now, the market story isn't everything is collapsing. The story is rotation. And rotation is sneaky. It can make the index look like it's stuck in place while entire neighborhoods inside the market are being renovated overnight. Here's what I mean. When money rotates, it doesn't vanish. It relocates. It's like a stadium crowd at halftime. The seats are still full, but the aisle traffic makes it feel chaotic if you're only watching from one angle. Over the last several weeks, you've seen money leave a lot of the flashiest, most crowded growth corners. Software, mega cap tech, anything that had that AI halo around it. And it has drifted into sectors that people used to ignore. Energy, industrials, materials, consumer staples. And the funny part, the headlines will tell you those are the safe areas. But safety and popularity are not the same thing. Sometimes the safe trade is just the trade everyone ran into at the same time because it was the closest open door. And when everybody squeezes through the same doorway, prices get distorted. That's not philosophy, that's just supply and demand. In fact, based on recent market updates, this rotation has been strong enough that you can have a year where the real economy sectors are doing surprisingly well. The broad index barely looks excited because the index is still dominated by a small group of giants. So you can feel like the market is fine if you own the stuff getting the inflows, or you can feel like the market is breaking if you're concentrated in what's getting drained. Same market, two totally different realities. Now here's the retention moment, okay? Because once you see that, the next question is obvious. If money is rotating out of the popular names and into the boring names, does that mean the boring names are the new winners? Or does it mean we're watching the crowd do what it always does, chase what already moved? Because those are two very different conclusions. And this is where I'm going to challenge a common assumption. A lot of people look at beaten down tech and say opportunity, and a lot of people look at ripping defensives and say safety. But the market doesn't reward labels. It rewards price paid versus cash produced. So the actual question is, what are you paying for growth right now? And what are you paying for comfort? Let's talk about comfort first. When you buy a defensive stock after it's already been treated like a lifeboat, you're not buying defense anymore. You're buying a crowded trade, and crowded trades don't announce their exits. They just stop going up. Then one day, the same people who called it safe will call it dead money and they'll leave. And you'll be the one holding it, wondering why a boring stock suddenly feels like a roller coaster. So if you've had positions that ran hard because the market rotated into them, it's not crazy to trim them back. That isn't fear. That's gardening. You cut back what grew too fast, so the whole thing doesn't snap in a storm. And if you're doing that, well, seriously, if you're successful, share your success story in the comments so others can stay motivated. Now, flip it. What about the stuff that got hit? This is where a lot of people get seduced by the bargain sign because you see a quality business down and you think, well, it's on sale. Maybe. But here's the uncomfortable truth. Sometimes something is down because the price was silly, and sometimes something is down because the narrative is changing, and sometimes something is down because the market is just having a tantrum. Those three look identical on a chart. So how do you tell the difference? You don't do it by chanting "buy the dip." You do it by asking one question that almost nobody asks in the moment. What would have to be true for this to stay down for a long time? That's the question, and it forces you to separate temporary disappointment from permanent impairment. Now let's connect that to the AI story because this is where the conversation gets messy online. You'll hear AI kills software, and then you'll hear no incumbents have MOs, and people argue like one side has to be totally right. But that's not how disruption works. Disruption is selective. It's a filter, not a bomb. Some software companies will get replaced because they were basically fancy spreadsheets with marketing. Others will survive because they're woven into how the world actually runs. And if you've ever worked inside a big organization, you already know this. The hardest thing on earth isn't writing code. The hardest thing on earth is changing process. So yes, AI tools can spit out prototypes faster, but migrating a decade of workflows, approvals, integrations, and compliance constraints, that is slow, that is political, that is messy. And that's why in the real world, disruption often hits the outer edges first, then slowly works inward. So when you hear software is dead, just remember that's a headline designed to make you feel something, not a conclusion designed to make you money. Now, I want to circle back to the technical breakdown fear because this is where people confuse symptom with cause. Technical weakness is often a reflection of uncertainty about macro, and right now, the macro story is complicated. On the inflation side, the latest publicly available numbers show inflation has cooled compared to where it was. And the most important piece of that puzzle is housing-related costs. If shelter costs are easing, it takes pressure off the headline. And it's not because rent is the only thing that matters, but because shelter is a huge slice of what the CPI is trying to measure. And the way it's measured has lags built into it, which is why you can have private market rents moving first and the official shelter measure catching up later. So when someone says inflation is collapsing overnight, that's usually wrong. And when someone says inflation is permanently stuck, that's usually wrong too. It's more like steering a cargo ship. The turn happens slowly, and then you suddenly notice you're headed a different direction. Now, I want to do something script style here because this is where the internet loves to blur lines. Let me read you the kind of post people are sharing in plain English. It'll say something like, "We've tried that level a bunch of times. We can't stay above it. The short-term trend line is slipping. The medium-term trend line is next. When the short term slides under the medium term, that's your confirmation. And once confirmation hits, the drop accelerates. And then it'll finish with, this is an opinion, this is the chart." Okay, that sounds authoritative, but here's what I did. I pulled the chart. I pulled the broader market internals. I looked at the sector tape. I looked at the rate backdrop. I asked one simple question. Is the chart describing reality, or is it describing one slice of reality? Because a chart can be technically right and still lead you to the wrong decision. And the reason is timing. Technical signals often show up after the move, not before. So if you treat them like an early warning system, you get whipsawed. If you treat them like a risk management dashboard, they can help you size your exposure. That's the right role for them. Here's an analogy that might land. Imagine you're driving and your tires start losing grip. A moving average cross is like the traction control light on the dashboard. It's telling you what already happened. The wheels slipped. It's not the pothole that caused it. So if you see the light and you slam the brakes, you might spin out. But if you see the light and you ease off the gas, straighten the wheel, and slow down, you regain control. Same information, different response. Now let's get more specific about this 1 month under 2 month fear. People treat it like a trapdoor because they assume it means the crowd agrees it's over. But what it really means is that recent prices have been weaker than earlier prices for long enough that the average changed. And averages only change after you feed them data. So yes, if we stay weak for long enough, you can see that cross, but the cross doesn't create sellers. The cross reflects sellers. So the next question, again, is not will it cross, it's are there new sellers left? And that's where sector rotation comes back in because rotation can create the illusion of new sellers when it's really the same capital moving from one bucket to another. So let's talk about buckets. Picture the market as a set of big buckets on a conveyor belt. Growth bucket, value bucket, defensive bucket, cyclical bucket. Money isn't a puddle, it's a flow. It sloshes. And when the belt speeds up, when volatility rises, those buckets slosh harder. So if you're watching one bucket, you think the world is ending. If you're watching the whole belt, you think, okay, the system is still running. It's just messy. Now, here's the plot twist. A lot of this rotation is being justified with fundamentals, but a lot of it is really being driven by positioning and narrative. That's why you can see boring companies get treated like they're growth stocks, and you can see growth companies get treated like they're busted value traps. Now, I want to touch housing for a second because people keep using housing as a national on-off switch for the economy. Housing is not a national story, it's a neighborhood story. One metro can feel frozen while another still clears listings fast. And if you've ever tried to buy or sell a home, you know this in your bones. The reason it matters for markets is not the headline price index. The reason it matters is the wealth effect. If people feel richer, they spend. If people feel poorer, they pull back. So the real question isn't, are home prices down? The real question is consumption changing? And that's why we watch employment, wages, and credit conditions alongside housing. Now back to energy, because there's a subtle contradiction happening that most people miss. On one hand, everyone knows AI build-out needs power. Data centers aren't free. They need electricity, they need cooling, they need infrastructure. So the market says, buy power, buy fuel, buy pipes. Makes sense. On the other hand, global oil markets are still dealing with supply management and demand forecasts that are not straight up. So you can absolutely have a world where energy equities are strong for a while because the trade is popular, even if the underlying commodity is choppy. And that's why you have to separate energy demand for electricity from oil demand for transportation, and even from natural gas demand for generation. Different drivers, different time horizons, different bottlenecks. So when you hear one big simple narrative, energy up because AI, remember, the market loves simple stories, and reality is layered. Now the dollar piece again, if the dollar catches a bid and the Fed is not rushing to cut, that tightens financial conditions without anybody changing a single law. And that matters because the market has been conditioned to expect rescue. So whenever the tape gets ugly, people ask, where's the pivot? But if inflation is cooling slowly and policymakers are still watching the data, the pivot may not be as fast as the market wants. And that's how you get this frustrating environment where nothing feels clean. Rallies are real but short. Pullbacks are real but not catastrophic. And the index keeps hovering under that ceiling. Okay, now we can land this plane. Now, why does this matter for your portfolio? Because disinflation changes what the market is willing to pay for. When inflation feels hot, people crave stuff you can touch: commodities, energy, real assets. When inflation feels like it's cooling, people start thinking about duration again. Growth, long cash flow streams, things that benefit when rates aren't rising. And that's part of why you can get this weird push-pull, energy and staples catching a bid while growth sells off even as inflation data looks cooler. It's not always rational. Sometimes it's positioning, sometimes it's fear, sometimes it's just a reflex. Now, a quick fresh context check. The Federal Reserve has been holding its policy rate in a mid-3 range and signaling it's going to stay data dependent. So the market is constantly gaming the next move. Every print becomes a referendum. Every chart becomes a prophecy. And that's where volatility sneaks back in. In fact, if you look at the fear gauge data, it's been elevated compared to the calm stretches people got used to. And higher volatility does two things at once. It punishes leverage and it rewards patience. Now, let's talk energy, because this is one of those places where the market's internal story matters more than the headline. Energy has been one of the stronger areas so far, and not just because oil moved. It's also because investors are linking energy to power demand, data centers, and the whole AI infrastructure build-out. That part is real. But here's the skeptical twist. Strong sector performance doesn't automatically mean the sector is correctly priced. Sometimes it means the sector is crowded. And if energy stocks run ahead of actual energy prices, or if the narrative runs ahead of the cash flows, you can get a gap that has to close one way or the other. Either the fundamentals catch up or the price does, and the market doesn't tell you which one ahead of time. So if you're hearing people speak in absolutes, energy can only go up, or tech is finished, or this is the new era, that's usually your cue to step back and ask, is this a thesis or is this just a mood? Now let's add the geopolitical layer, because this is where markets love to overreact. Recently, there's been chatter reported in mainstream financial news that Russia is considering moving back toward dollar-based settlement mechanisms in certain contexts. If that happens in any meaningful way, it matters for one reason: demand. If more global trade runs through dollars, you need more dollars in the system to grease the skids. And that tends to support the dollar. Now, I'm not telling you this is guaranteed, and I'm not telling you it happens overnight. But it's the kind of trial balloon headline that can make markets re-prick quickly because it touches the core plumbing of global finance. And if the dollar strengthens, it creates second-order effects. It pressures commodities priced in dollars. It makes it harder for some overseas borrowers, it changes relative returns, and it can even amplify the rotation we're talking about, because a strong dollar can be a headwind for certain parts of the market while being neutral for others. So here's a question for you. Do you think the market is reacting to reality right now, or to a series of narratives stacked on top of each other? Drop your answer, because I want to see where your head is. Now let's zoom into the high 6,000s technical fear again, because I promised you we'd separate signal from noise. The most common way people get this wrong is they treat the index like a single stock. But the index is an average, and averages can lie. You can have half the market in an uptrend and half the market in a downtrend, and the average looks like it's doing nothing. So when people say the market is breaking, what they often mean is, my part of the market is breaking, which is emotionally valid, but analytically incomplete. Here's the analogy I want you to remember. Think of the market like a big airport baggage carousel. The belt keeps moving. Your bag might be missing. Someone else's bag might show up twice. And if you stand there staring at one corner, you'll swear the whole system is broken. But the motion is continuous, and the distribution is the drama. That's rotation. Now, what about the moving average cross? Let's be practical. If the short-term average crosses down, it often coincides with weakness already underway. And yes, it can sometimes precede another dip, but the market doesn't crash because a line crossed another line. The market crashes when liquidity evaporates and forced sellers show up. So the better question isn't, will the averages cross? The better question is, who is forced to sell if we get another downgrade in price? Are there big systematic strategies that de-risk? Are there leveraged players who get margin calls? Are there pension rebalances? Are there vault target funds? Those are the mechanics. And if you've been through enough market cycles, you know the difference between a sloppy pullback and a true air pocket is not the chart pattern. It's the speed. And the way you see speed before it hits you is through volatility. So if you want one dashboard number to watch, not obsess over, just watch, it's volatility, because that tells you whether the market is calmly reallocating or panicking. Now, here's a part the internet usually skips: seasonality. No, I'm not saying you trade your retirement on a calendar, but there are stretches of the year where liquidity is thinner, positioning is weird, and headlines carry more weight than they should. And when you're in that kind of window, technical levels feel stickier. That doesn't mean they're magical. It means fewer buyers are willing to swing at pitches. So the same resistance can hold longer than logic says it should. And then when the mood changes, price can jump right through it like it was never there. Now let's talk about the behavior side, because this is the part that determines whether you win or lose, regardless of what the market does next. There's this mindset that's become more common in the last few years. I call it financial nihilism. It's the idea that the game is rigged, so you might as well gamble. And I understand where it comes from. Costs are high. People feel behind. It's easy to look at social media and feel like everyone else got rich except you. But here's the brutal truth. Gambling feels like control. Discipline is control. And those are not the same thing. If you want to build wealth, you don't need a hero trade. You need a repeatable process. You need to avoid catastrophic mistakes. And you need to stay in the game long enough for compounding to do what it does. Because based on recent reports about retail trading behavior, a lot of people manage to be active for years and still not meaningfully improve their outcomes, even while the market itself moved higher over that same stretch. And that's not because they're dumb. It's because the incentives are backwards. It's dopamine. It's push notifications. It's you could be rich by Friday messaging. So I'm going to ask you something that might sting a little. When you open your app or check your portfolio, are you investing or are you checking a scoreboard? Be honest. Nobody can see your answer except you. Now, let's connect this to the rebalancing point, because this is where adults separate from the kids financially speaking. Rebalancing is boring. It is literally doing the opposite of what your emotions want. When something you own is ripping, your brain says add more. When something you own is dumping, your brain says get rid of it. Rebalancing says trim what got hot and consider adding to quality when it's hated. Not because you enjoy pain, but because you're buying future return, not past performance. And the simplest version of that is this. If you have positions that got wildly overweight because they ran, you trim them back to your target. That's it. No drama, no prediction, just risk management. And if the market rips after you trim, good. You still own some. If the market dumps after you trim, also good. You reduced your exposure before the slide. That's how you stay sane. Now, let me pivot into the AI piece, because this is the story that's hiding inside the market story. If you've noticed software and AI adjacent names getting sold, part of that is valuation, part of that is rotation, and part of that is a very real question. How fast is the tool improving? And this is where things have gotten spicy lately, because you've got high-profile executives on record saying that a large chunk of routine white-collar computer work could be automated on roughly a yearish timeline. Now, do I think that means every job is gone next year? No. And I'm skeptical of anyone who speaks that confidently, because people love to sell the future. But I do think this is the right way to interpret it. The capability curve is steepening, and that changes incentives. If you're a business owner and you can replace a task with software that doesn't call in sick and doesn't need health insurance, you're going to try. Not because you're evil, because competition forces you to. So the risk isn't that your entire profession disappears overnight. The risk is that the entry-level rung gets removed. And when the first rung gets removed, a lot of people can't climb the ladder. That's the part we should take seriously. And it's also why you're hearing talk about policies like some form of basic income in the future. Because if productivity rises and labor demand changes, societies scramble to patch the gap. But I want to be very clear. Even if some kind of basic income shows up someday, it will not replace purpose. Humans need to be needed. And that is not a political statement. That's just psychology. So if you're thinking, okay, what do I do with this? Here's the answer that isn't sexy, but actually works. Build skills that complement the tools, build financial margin, keep your expenses flexible, keep your savings rate real, and treat your portfolio like a machine designed to keep you free, not a casino designed to keep you entertained. Now, we've covered a lot of ground, so let's tie it together into an actual game plan, because a script like this is useless if you walk away more anxious. So here's what I think the market is actually saying right now. 1, the index is stuck under a visible ceiling, and the trend is choppy. That's a warning, not a death sentence. 2, the internals are rotating, and that rotation is making people misread the big picture. 3, volatility is higher than the sleepy periods people got used to, which means position sizing matters more. 4, inflation appears to be cooling, especially through housing-related measures, which changes the rate story and the leadership story. 5. Energy strength is real, but it's also vulnerable to crowding and to a mismatch between narrative and cash flow. 6. Geopolitical headlines can move the dollar narrative, and the dollar narrative can move everything else. 7. The AI wave is accelerating, which is both an opportunity and a threat, depending on whether you adapt. Now, the cliffhanger. So, what happens next? Here's my honest view. We're probably going to keep getting rallies, and those rallies are going to tempt people into thinking, see, it's fine. And then we're going to get pullbacks that tempt people into thinking, see, it's over. And the people who get chopped up will be the ones trying to be right about every wiggle. So instead, here's the framework. If you're heavily concentrated in one theme, especially a theme that was crowded, use strength to rebalance. If you're sitting on some cash, don't try to be cute and nail the exact bottom. Decide what you want to own. Decide the price range where you're comfortable adding and scale in like an adult. If you're newer, focus less on prediction and more on consistency. And if you're watching this and thinking, I'm behind, I need a miracle, I want you to hear me. Miracles are rare. Processes are common. And the people who win in markets are almost always the people who are still standing when the mood flips. Now, one more question for the comments. What's the one thing you're watching that would make you change your stance? Volatility, inflation, the dollar, or sector leadership? I'm genuinely curious. And if you haven't subscribed yet, please do it now. It takes a second, and it helps the channel a lot. All right, last thing. Everything you heard here is for education and perspective. I'm not your financial advisor. I don't know your full situation, and markets can humble anybody. Do your own research, think in probabilities, and make decisions that let you sleep at